Welcome to the Deep Dive, where we cut through the noise and get straight to the insights that matter for you. Today, we're uncovering something, well, pretty remarkable actually, India's investment landscape. And get this, demat accounts, your essential gateway to the stock market, they've absolutely skyrocketed. We're talking a surge from, what, 4 crore in 2020, all the way up to an astounding 20 crore by August 2025. That's just an incredible, nearly five-fold increase in just a few years. It really signals a nation's growing embrace of equity. Our mission today is to really explore this dynamic Indian stock market. We'll dive into the powerful underlying political currents, both international and domestic, that are shaping its trajectory. And crucially, we're going to try and arm you with the knowledge to build what we're calling a no-regret portfolio for your financial future. We've pulled together a diverse stack of sources for this one: market reports, expert analyses, personal finance articles, giving us, hopefully, a pretty comprehensive view. The sheer volume of new investors is just, well, it's fascinating. Let's try and break this down.
It really is fascinating. And it's more than just numbers, isn't it? It feels like a profound shift in India's, let's say, financial DNA. We're witnessing a structural transformation, really, in how savings are managed and grown. Our aim today is to connect these dots, reveal the sort of big picture behind this unprecedented surge, and show you why understanding these dynamics is, well, more important than ever if you want to navigate these exciting, but yeah, complex waters strategically.
Okay, so let's kick off with that demat account explosion then. The numbers are just striking. 4 crore accounts in 2020 swelled to over 18.5 crore by end of 2024, and then rocketed past 20 crore by August 2025. That's a huge influx, almost a fourfold jump in just a few years.
Yeah, it's a massive jump. And this whole phenomenon, it's driven by a kind of confluence of factors, wouldn't you say? There's the incredible ease of opening accounts digitally now, the widespread adoption of smartphones, putting market access literally in the palm of your hand, and of course, a generally favorable market environment, at least for a good chunk of that time, that offered attractive returns. That certainly drew many new entrants in.
And the demographics are interesting too, right? The youth participation.
Absolutely key. What's particularly noteworthy is that demographic shift. Roughly 75% of these new accounts opened by investors under the age of 30. That really highlights a generational embrace of equity investing. It's quite something.
That is a significant demographic pushing this trend forward. And okay, while the pace of new account openings might have moderated a bit in 2025, the overall trend is still unmistakably clear. India is committing to equity investing. We also saw the impact of that record-breaking year for IPOs, didn't we? Around 90 companies raising nearly 1.6 lakh crore in 2024.
Oh, definitely. That IPO activity was huge. It brought in countless new investors. Sometimes you even saw families opening multiple accounts, just to try and increase their chances of getting a share allocation in those hot IPOs.
Right. Interesting strategy.
But, this isn't just about more people investing. It signals something deeper, a fundamental shift in market power, actually. For the first time in, a quarter century, domestic institutional investors, DIIs, have actually regained dominance in the Indian stock market.
Okay, that sounds like a really pivotal development, a huge deal, maybe. Can you give us a bit of historical context? What does that shift really look like? And I guess, what does it tell us about how India's market is maturing?
Sure. So, to put it in perspective, foreign institutional investors, FIIs, they were first permitted back in 1992. And by March 2014, their investment significantly dwarfed DIIs. FIIs were investing, I think the number was more than 15 times what DIIs were. A huge gap. But the last decade, a dramatic reversal. As of March 2025, DII investment hit an all-time high 14 lakh crore. Yeah. In contrast, FII investment stood at 10 lakh crore. That's nearly 29% lower than the DIIs. So what this means practically is that DIIs are now the primary force influencing the market direction, day to day, week to week. We've even seen the data shift. The correlation between FII activity and the Sensex, it became almost negligible over the last decade, while at the same time the DII Sensex correlation rose significantly between April 2014 and June 2025.
So DIIs are firmly in the driver's seat now. Does that mean FIIs are just, finding better opportunities elsewhere globally? Or is there maybe a deeper concern about India's valuations, how expensive the market looks? What's a takeaway for us watching this?
That's a really crucial question, and probably a bit of both, honestly. FIIs obviously have global options, but a significant factor does appear to be market valuations. The average PE ratio, basically how much investors are willing to pay per rupee of earnings, it's climbed. It went from around 18.5 between 2000 and 2014 to roughly 23.7 between 2015 and 2025.
Quite a jump.
It is. And this higher premium, it potentially makes Indian equities look less attractive, maybe less of a value play for FIIs comparing globally. So for your portfolio, what does it suggest? Maybe a renewed focus on understanding the local growth stories, the strength of domestic capital.
Makes sense. And despite this kind of shifting dynamic, India's overall performance has still been pretty impressive, hasn't it? Indian equities delivered, what was it, an attractive 18% annualized return over the last 5 years as of May 2025. That's significantly outperforming global markets, developed markets, and it absolutely trounced emerging markets like China. China saw a 2% decline in May 2025, I read.
Exactly. That long-term outperformance is undeniable. And small caps really led that charge, right? With
Yeah.
36% returns over those 5 years. Phenomenal.
Truly remarkable. But even with strong fundamentals like that, no market just goes straight up. Our sources definitely highlight some recent turbulence, some headwinds. What's going on there?
Indeed, yeah. That long-term view is great, but we have to acknowledge the recent picture too. The Indian market seems to have experienced what people call a time correction over the past year or so, say August 2024 to August 2025. A time correction basically means prices haven't moved much, they've gone sideways, allowing earnings to hopefully catch up to those valuations rather than prices just surging ever higher. And during this period, the Sensex and Nifty 50 actually delivered less than you would have got from a bank fixed deposit.
Ouch.
Yeah. And mid-cap and small-cap indices were actually down about 6%, with the Nifty down around 9%. So definitely a pause in that upward march.
So it seems like we've got this fascinating tug of war happening. On one side, you have robust mutual fund SIP inflows, people consistently putting money in, providing this critical layer of support. But on the other, you've got significant selling pressure from foreign investors, maybe some promoters too, pulling the market down. We saw huge FII selling, right? Over 34,000 crore in just the first half of August 2025, especially in IT and financials.
That's right. A significant outflow in a short period. And this fascinating interplay, it really underscores the complexity, doesn't it? While that domestic liquidity from SAPs acts as a kind of buffer, sustained FII selling can create short-term volatility, especially in those sectors popular with foreign funds. It just highlights why you need to look beyond the daily noise and understand the deeper structural drivers. Okay, so speaking of drivers, let's broaden the view a bit. What about the global stage? How are international political economic factors, things like, say, potential U.S. tariffs under Trump or the ongoing Russia-Ukraine conflict, how are they impacting India? Right, the external environment. Well, what's noteworthy here is India's relative, let's say, insulation compared to some other economies. Take potential U.S. tariffs. While they could certainly pressure specific sectors, maybe metals, solar, electronics, India's overall economy is just less export-dependent than many others. And critically, if you look at listed Indian companies, their exposure to directly affected areas, like maybe gems and textiles exporting directly to the U.S., it's relatively low within the overall market context.
Okay. So some impact, but perhaps manageable.
Potentially, yes. Now, the Russia-Ukraine war, that's a bit more complex. It has a kind of dual effect. On one hand, it definitely creates raw material risk. We've seen that impacting input costs for sectors like fertilizers, the auto industry. That can squeeze their margins, make investors a bit nervous. But on the other hand, it's also acted as a powerful catalyst, hasn't it? It's reinforcing global demand for defense spending, accelerating the transition to solar energy, and these trends directly benefit certain Indian companies in those specific subsectors.
Interesting. A double-edged sword, almost.
In some ways, yes.
So that sounds like a complex global picture, but it also seems to suggest India has significant internal strengths to fall back on. Let's shift focus back home then. What about India's domestic policy stability and those internal growth drivers? That seems like a really solid foundation. Are there any potential, caveats or emerging concerns within the domestic policy landscape that our sources might be hinting at, even if they're minor?
Well, looking closely at the sources, India's robust policy framework really stands out as a key advantage right now. The current government continues to emphasize infrastructure development, indigenization, boosting local manufacturing and green energy initiatives, big themes. And this policy continuity creates a stable environment. That's something that really bolsters investor confidence, both domestic and foreign.
Stability is good.
Definitely. And then you look at the fiscal health. India's prudent management seems evident. The FY25 deficit, for instance, matched its target at 4.8% of GDP. The projection for FY26 is around 4.4%. Those are seen as responsible numbers. Add to that the RBI's generally pro-growth stance, including some recent rate cuts. It paints a supportive economic climate overall. Oh, and let's not forget the monsoon. A good monsoon forecast really helped cool food price inflation for, what, 6 consecutive months?
Always good news for the household budget, making the daily folly more affordable.
Exactly. So, while no policy is ever perfect, and you can always find potential challenges if you look hard enough, the sources generally highlight a strong, consistent domestic direction, one that prioritizes growth and stability.
Okay, so putting it all together, this incredible dynamism, you've got the surge of new investors, the shift in power towards domestic capital, this push and pull of global versus domestic factors. What does this all actually mean for, for your investments? For the listener trying to navigate this, why is building that solid, resilient, no-regret portfolio so incredibly important right now?
This is really the heart of it, isn't it? The central question for every single investor. And the core financial reality is, well, it's pretty stark. Bank fixed deposit returns, FDs, they're often disappointingly low, right? Hovering around 6-7% per annum, maybe a bit more if you're lucky. Meanwhile, inflation is running hot, eroding that purchasing power. So a structured equity portfolio, done thoughtfully, offers not just the potential for growth, but potentially a second income stream over the long term.
Right, the potential returns are much higher, historically speaking.
Much higher, yes. Many investors have seen impressive annualized equity returns, far outstripping FDs. It makes it a compelling path to wealth creation, provided you understand the risks. And this is precisely why we're talking about a no-regret portfolio. It's essential now. It's about having conviction, even when things feel uncertain. It's designed for, let's say, disciplined upside, but also controlled downside, trying to be untethered from the short-term market noise, but adaptive to the underlying structural growth in the economy.
A no-regret portfolio. I really like that phrase. It captures the goal well. So how do we actually go about building one? What are the actionable strategies? Let's unpack that.
Okay, let's break it down. The foundational advice, it's timeless, really. Diversification is absolutely key. You simply cannot or shouldn't put all your eggs in one basket. Spread your investments across different asset classes, stocks, bonds, maybe some FDs, mutual funds, perhaps real estate if that's part of your plan. And also diversify across different sectors within equities. This approach lets you customize your portfolio based on your specific risk tolerance and your financial goals.
So tailoring it is crucial.
Absolutely. And a critical piece of asset allocation wisdom tied to that is you should probably never put 100% of your capital into equity. Only invest money in equities that you realistically won't need for, say, at least 8 to 10 years. Give it time to ride out the cycles.
That's a really important point about the time horizon.
Crucial. And generally, it's better to remain invested rather than trying to time the market perfectly. Market timing is incredibly difficult, even for professionals. So if you were perhaps waiting on the sidelines for a market correction to invest, maybe now, with the market having had that time correction, could be a reasonable time to consider entering, perhaps by staggering your investments over, say, 1 to 3 months to average out your entry price.
Dollar cost averaging, basically.
Exactly. And for risk management, think about practical tools. Stop-loss orders can be invaluable. They automatically sell a stock if it falls to a price you've predetermined, helping limit potential losses. It takes the emotion out of it sometimes. Also, consider investing in non-cyclical industries, companies providing essential goods and services people need regardless of the economy. Think utilities, consumer staples. And look at stable, large-cap blue-chip stocks to kind of anchor your portfolio and potentially minimize losses during downturns.
So build a solid core first.
Precisely. A balanced approach often involves blending those large-cap anchors for stability. With carefully selected mid and small cap stocks that offer higher growth potential, understanding they come with higher risk. And don't forget to incorporate some defensives, maybe some select public sector undertakings, PSUs, banks, power companies as ballast, for stability.
Okay, ballast. I like that. And what about themes? Are there specific areas look promising?
Yeah, look for high conviction thematic leaders. Themes supported by those strong domestic growth drivers we talked about. Things like defense indigenization, infrastructure and capital expenditure, CapEx cycle, the consumption recovery story, digital-led exports, essential services. These seem to have structural tailwinds.
That's a fantastic breakdown of strategies. Could you maybe give us just a few illustrative examples, not endorsements, of course, but just the types of companies from the source material that might fit into those categories, just for context?
Sure, just for illustration, based on the sources. For, say, low-risk, steady compounders, you might see names mentioned like ICICI Bank, LT, Titan, REC, NTPC, PowerGrid, familiar names. For more balanced growth plays, examples could include HAL, BAL, and defense, maybe Polycab, KEI and cables, IRCON and infrastructure. Then you have what might be called high beta asymmetric opportunities. These tend to move more than the market. Higher risk, higher potential reward. Here, you'd allocate modestly, use stop losses diligently. Examples might include Dixon, Wary, VMM, NICA, BDL, and perhaps some cautious speculative plays where you'd keep the position size small due to earnings sensitivity or cyclical factors, maybe a BHEL or a Forest Motors, just examples of the types of thinking.
Got it. Very helpful categories.
And finally, never underestimate the power of systematic investment plans, SIPs, especially for long-term wealth creation. Our sources show really strong historical annualized returns. That example you mentioned earlier, a 10,000 monthly SIP over 5 and 10 years. In certain small cap funds, like Nippon India Small Cap, reportedly yielded something like 26.4% over 5 years and 24.24% over 10 years. Those are powerful compounding numbers, though past performance isn't future guarantee, obviously.
Those SIP returns really do highlight the potential of disciplined long-term investing. And
Yeah.
just briefly, speaking of income, some people also think about stock trading as a potential side income source. What are your thoughts there, given this whole landscape?
Yeah, trading is a side income. It's certainly possible for some, but, and this is a big but, it absolutely requires sufficient market knowledge, a very disciplined strategy, and a really thorough understanding of the risks involved. It's significant. Opening a demat account is just the first easy step. It's absolutely crucial that you only invest or trade according to your personal risk appetite, money you can afford to lose. It's a very different game than long-term investing. It demands much more active engagement, constant monitoring, and very strict risk management. Not for everyone.
Good points. Definitely requires a different mindset and skill set.
Well, what an illuminating exploration this has been into India's whole investment story. We've uncovered the phenomenal growth, particularly that incredible surge in demat accounts and the powerful rise of domestic investors taking charge. We've explored that balancing act, global political ripples versus India's strong domestic policy continuity and growth drivers. And most importantly, I think we've laid out some really robust strategies for crafting your very own no-regret portfolio. One built on conviction, diversification, smart risk management, and hopefully perfectly tailored for the opportunities ahead.
Indeed, it really is a market defined by both rapid evolution and this underlying strength. It's quite unique. And in this dynamic environment, where domestic power is clearly growing, but global factors still cast a shadow, it's just crucial for you, the listener, to be proactive, to stay informed, and to be strategic in your financial decisions.
Absolutely. So here's maybe a final thought to ponder as you navigate your own financial journey. In this rapidly evolving market, influenced so much by domestic strength, but also those undeniable global ripples, what aspects of your own financial planning, your own mindset perhaps, might be holding you back from truly adapting and thriving? Is it maybe time to reassess not just your investments, but perhaps your own conviction, your own approach, especially when faced with uncertainty? Something to think deeply about.